All right, everyone. Welcome to class 3 of our day trading course. Today we're going to talk about choosing the right stocks. Okay, so we've already talked a little bit about I've introduced day trading. I've talked a little bit about risk management, choosing the right stocks, choosing the right patterns. The thing that we were really talking about yesterday was how to manage your risk in all your trades, and the fact that risk management is really the most important concept for you to understand in order to be a successful trader. Stock selection and your ability to pick good stocks is second to risk management. Okay, but a close second. Being able to choose good stocks is important. All right, so today we're going to review how to choose the right stocks. And this is really important because out of the thousands of stocks available on the market to trade, there's really only a small handful that I consider worth trading. Right? Because I have a very unique strategy for trading the markets, and it requires a certain set of stocks. And it's not going to work on, in fact, the majority of stocks. Okay, so we know that over 60% of the market, the volume in the market is high frequency traders, right? It's the algorithms, the institutional traders. We know they dominate the market. We know they're the ones that are making money every single day. So as retail traders, we already have a disadvantage. Right? We're not able to trade millions of shares. We're not able to profit from the spread. As soon as we buy something, we're immediately at a loss just because of the spread. If there's a 5-cent spread, as soon as we buy, we're at a 5-cent loss. So it's really hard for us to find an edge in the market. But there is an area where I focus and where I feel that I do have an edge, and that's by focusing on patterns, right? Because computers are not very good at identifying patterns. So retail traders, like all of us, we can focus on the patterns and use that as our edge in the market. Okay, so the only thing is that pattern-based trading doesn't work on a lot of stocks. The reason patterns work is because retail traders are watching them develop. So as we watch these flags forming and we see there's a very clear line of resistance, say at $12, it becomes very obvious to us that the buy spot is at $12. Right? But if no one's watching that chart, then no one sees that pattern unfolding. So it's kind of like, there could be patterns on stocks that have no volume, but they're not worth trading because they're not going to have good follow through. So not only do we want to find patterns, we want to find patterns on stocks that are going to have good follow through. Right? What's the point of taking a flat top breakout if there's no follow through? So in order to reduce our risk of losing and increase the probability that we'll be in winning trades, we have to focus on only trading strong stocks with high relative volume. Okay, so with high frequency trading, HFT trading, being 60% of the overall market volume, we know that it's going to be higher on some stocks and lower on other stocks. Right? There's stocks where there might be 80% high frequency trading volume, right? And there might be other stocks where it's only 30% or 20%. Okay, so it's not to say that high frequency trading is necessarily our enemy. It's just that high frequency traders are not going to participate in the breakout trades that we're interested in trading. Okay, the people that are going to buy breakouts are retail traders. So we want to focus on stocks with lots of retail traders. And we don't want to get fooled into buying patterns that are being formed by high frequency trading, right? Because those patterns are, just the result of the way the computers are shifting their shares. It's just a coincidence that we're able to see a pattern, right? It just happens to be there. It doesn't really mean anything. Okay, so what we have to focus on are stocks with high relative volume. That's how I identify a pocket of safety in the market. I only trade stocks with very high relative volume. So that is one of the most important things to take away from this class today. Only trade stocks with high relative volume. And we'll go into defining relative volume in a few minutes. Okay, so in other words, trade high relative volume, we only trade extreme stocks. Okay, so that's how I combat the high frequency trading. I only trade extreme stocks. So if we look at almost any single stock, you'll see a day on that stock that had a huge volume spike, and usually that correlates with a really big big percentage gain or loss. Those are the days that we trade that stock. Okay, so that stock, 365 days, well, there's not that many days to trade, but over the last 52 weeks, you look at every single day on the chart, on the daily chart, and you might only see 2 days where it had really heavy volume. Well, those are probably the only 2 days we would have traded that particular name. So the rest of the time, it's just resting, it's just trading, whatever. There's high frequency traders, trading it. There are swing traders maybe buying it, value investors maybe trading it. But as day traders, as high-speed day traders, we're not going to be interested in those stocks, except for the 1 or 2 days a year where they're having a major event. Whether it's because they reported good earnings, there's some other news catalyst out, whatever the reason is, those are the only days that we'll be trading those stocks. Okay, so we have to follow the volume in the markets. All I do all day long is chase volume. I just look for volume. So I'm scanning for news because I know news creates volume. And I'm just scanning for volume, and then sometimes I have to go search for the news. I may not know what the news is, but I see a stock ripping up, and I want to figure out why. So I try to find out if there's a catalyst. But all I'm doing all day long is following the volume around the market. And there's usually a small handful of stocks each day that have tons of relative volume. There's tons of day traders, but honestly, we all trade pretty much the same stocks. If you talk to other day traders this week and you ask them what stocks they're trading, odds are they're going to be trading pretty much the same names that we've been trading. And there's a reason. It's because those are the names that are easy to trade right now. They're the stocks that have lots of volume and are very volatile. But they're volatile in a way that is relatively predictable because they're going to trade in these patterns that we understand. They're going to form bull flags. They're going to form flat top breakouts. And whenever we see one of these familiar patterns forming, we know how to trade them. And we can incorporate that pattern into our strategy of how to trade momentum stocks. Okay, so now there are certainly traders that are going to be spending this week trading the VIX, trading the SPY, trading commodities, but that's not something that I do. I don't apply my strategies to the type of stocks, commodities, forex, anything like that. I don't apply it to financial instruments that don't have a lot of volatility. I don't apply it to a financial instrument that doesn't have a catalyst for a big move. Now, if there's a catalyst in one of the futures, I wouldn't trade it because I don't trade futures. If there's a catalyst in the SPY, well, that's going to be a global catalyst, and typically I don't try to trade those because they're, for me, just difficult to trade. There are times where especially back in 2012, 2013, 2014, when the FOMC meeting minutes would come out, where there would be a lot of volatility in the market. We would see the SPY suddenly tank and then shoot back up, and there was opportunity to scalp that breaking news, basically the same as we would scalp any other news play. But on a day-to-day basis, I wouldn't be trading the VIX and I wouldn't be trading the SPY because they're going to be choppy. They don't have the strong catalyst to make clean moves. So I only want to trade stocks that are going to have perfect setups. We're not always going to see perfect setups, but I only want to trade the best setups. Because look, the reality is, even when you only trade the best setups, you're still probably only going to be right 65 to 75% of the time, at best. And that's when you're trading the perfect setups. So if you're trading the less than perfect setups, just think about how quickly your percentage of success is going to fall, right? Maybe 50%, maybe 40% success. So why waste your time trading subpar setups or trading stocks that don't fit our criteria for being a stock that's worthy of trading? Okay, now similarly, I don't trade penny stocks. Chart patterns are almost irrelevant when you're talking about penny stocks because typically the penny stocks are highly manipulated. So any of the moves are just going to be, people manipulating the price action. So patterns that you see are pretty much worthless. So I don't trade penny stocks. I would not apply these strategies or patterns to any penny stocks. So no penny stocks, no funds, no ETFs, no index types of trades, no commodities, and I don't trade Forex. Okay, so there's a lot of stuff I don't trade, right? And this is a low volume example of a stock that on a day-to-day basis would be totally wasting our time to look at. So this has 500,000 in volume, right? But what can we take away when we look at this type of chart pattern, right? What does this tell us? I mean, we see it's very sporadic. There's a little burst of volume here, and then nothing, and then a little burst here, a little burst here, and then nothing. So what's going on here? I mean, this to me is just a stock that has almost zero retail interest, has a few buyers here and there, but is basically of no interest. And the only people buying it might be people that have a long-term position, and they might just randomly log on and add a couple shares or sell a couple shares. And it could just also be the high-frequency traders shifting shares a little bit. So this for me is a low-volume example of a stock that I wouldn't trade. Now, there are times when we'll take a trade on a stock that only has 500,000 in volume because all that volume came in a period of about 3 minutes, right? Volume surged in because there was breaking news, something like that. That could be worth trading. But a stock where we look at this at 2:30 in the afternoon, 3 in the afternoon, whatever, this is just not worth trading at all. So most of the students, both in the class and in the chat room, know that if they call out a stock like this, like, hey, check this out, I'm going to say right away, no, it's not a good stock. It doesn't have enough volume. So any pattern you think you're seeing, it's not worth it. Oops. In contrast, here's a high volume example. So this is Zillow. All right. And there was a day where we had a big surge right out of the gates. It surged up and then it started consolidating sideways. Okay. Very, very heavy volume. You can see the average volume. Let's see, for every 5-minute candle is probably 10, 15,000 shares. 1.8 million shares on the day. And there's a steady flow. It was heavy volume in the morning, which is typical. We like to trade in the morning when we have heavy volume. Consolidation mid-morning, and then a breakout. Looks like this breakout might have been just a little bit before lunchtime. Okay, so this is a stock that's worth applying patterns to because there's heavy volume. So when you see that there's a pattern here, which is an ascending wedge or a flat top breakout, there's a higher likelihood that it'll resolve in our favor because more people are watching this stock. It has more volume. And this stock not only had high volume on the day, it had high relative volume. It had above average volume because there was some good news out on it. Okay, and so look at the volume right here. It might be hard to see, but on this candle right here, which was the candle that broke to new highs, big volume spike of about 35, 40,000 shares. Okay, so that's the confirmation that people are indeed watching this stock and waiting for that breakout. So there are times where it'll seem like it's a very, very light volume. And you might ask yourself, is anyone watching this? I mean, I see that we're trending up and sideways here, but is anyone really watching this? And then maybe you buy it at $18, $17.99 for that whole dollar break, breaking that whole dollar of resistance, breaking the flat top. And all of a sudden you see this surge of buyers come in as we move up to 119 and then it goes up all the way to 120. Okay, so that's the type of chart that we're going to look at. That's the type of stock that's worth trading. Lots of relative volume, lots of high volume. Okay, so what creates high relative volume? High relative volume is the result of a catalyst. So relative volume is simply what is average for that stock. And it's relative for every stock, right? Some stocks trade with a ton of volume, like Bank of America. Other stocks trade on very light volume. Zillow, with 1.8 million shares, that's pretty light volume. Now I'll just check on another monitor here and see how much volume Bank of America traded today. Bank of America traded 100 million shares today. 100 million shares, right? But it only moved about, let's see, it had a daily range of 40 cents, 30 cents. So it really didn't make very much of a move, considering 100 million shares traded hands. right? Let's see. Yeah, that's 100. Yeah, 103 million shares. So considering that much volume, you know, traded hands today, it really didn't make a very big move. In contrast, a stock with relatively light volume, and actually Arna had a lot of volume today, so that's not a good example. But NDRM, this was a stock that moved up about 200% in one day on, let's see, 41 million shares. Okay, so 41 million shares, and this went up 200%. So volume is relative. 41 million shares compared to Bank of America doesn't sound like a lot, but for NDRM, that was a lot of volume. Okay, so in trade ideas, we can actually see what the relative volume is. It's actually a numerical input. It just puts it right there. This is the relative volume today. 1.4, 2.5, whatever. 1 is going to be average. 1 will be just flat average. It's on par with its typical volume. And anything above that is going to be high relative volume. Okay, so I look in general for a relative volume of at least 2 times average. But the higher the better, right? More relative volume means more people are watching this stock than usual. So why would more people be watching this stock? Well, it's simply because there must be news on it, right? There's either breaking news, earnings, activist buyer. It's possible that the stock is just experiencing a technical breakout, but typically a purely technical breakout is not going to bring in the big flood of buyers the way earnings or breaking news would. So if something is breaking out but it doesn't actually have any news on it, I'm usually going to be a little bit more cautious. I'll still keep it on watch because there's always the potential that we can get a short squeeze where a stock just irrationally starts running and shorts have to cover. That does happen from time to time, but generally we're going to see the cleanest moves on stocks that have a identifiable catalyst. All right, let's see. So, Sarepta. Now, there are times when a stock is going to be of absolutely no interest to us until, 12:51 or whatever time it was. Big news comes out, right? Breaking news. So here's Sarepta. Had absolutely no volume all morning. And then, 1250, 200,000 shares, and it spikes up from 22.50 up to $24. Okay, so it spikes up, point and a half, pulls in a little bit, makes another run. So all of a sudden in the middle of the day, a stock that really was of no interest to us comes into play. And now Sarepta, SRPT, is on our watch list as a candidate for a midday trade. Now, typically I trade only in the mornings. And if I'm going to trade in the afternoon, it's only going to be something that has very high volume and is in a extreme type of chart pattern. So I'll trade something in the afternoon that's a really big bottom bounce, a stock that's just washing out and I'm waiting to catch the bottom of it. Or I'll trade a stock like Sarepta that has breaking news. Those are really basically the only patterns that are worth trading in the afternoon because typically the afternoon volume is very light. So even if a stock has high relative volume on the day, the volume between the morning and the afternoon, it's always going to be heavier in the morning unless you have something like Sarepta that has the news. Okay, so we had a news play today on DKS, and we'll take a look at that in a minute. All right, so let's see. Here's a good chart of Sarepta. These are the days that we've traded Sarepta. I'm familiar with this stock because we've traded it several times. And you see the green arrow. We traded it on the day it had breaking news midday. We traded it on this day that it had a big, big gap down. And we traded it on this day that it had a big, big gap up. So those are 3 days in the past, looks like, year or so, 3 days in the last year that were worth trading, where this stock was on our watch list because it was either a big gapper or it had breaking news. So on those days, there was tons of volume and tons of retail traders, like all of us, were watching the stock, waiting for patterns to form where we could jump in for a low risk entry. So, the simple you might ask, well, why is everyone watching this stock? And the simple answer is people are watching this stock because it's volatile, because it's going to move a lot. If you're willing to take 20,000 shares, there's a potential that this stock on a big day will move 3 or 4 points and you can make $60,000. Right? So there are big traders with deep pockets that are going to be interested in these types of stocks every day because this is where they can make a ton of money. So for us, we may only take 2,000 or 3,000 shares of something like this, but we see the same opportunity for a big percentage gain. So whether you're trading 2,000 shares or 20,000 shares, the opportunity and the potential is for percentage gains is the same. Right? So that's why we're all focusing on these big, fast-moving stocks. So in the morning, my scanners focus on gaps. I look for stocks that are gapping up. And a gap is simply a stock that's opening higher than it closed yesterday. Okay, so overnight, there's going to be a price gap. And on the daily chart, you'll see this little window, and we call that the gap. Sometimes I call it a window or a little pocket. It's a little air pocket there. There's absolutely no resistance in this little pocket. Okay, so stocks gap up because they have good news overnight. All right, so to find these stocks, this small handful of stocks each day, I use stock scanners. I use trade ideas. Okay, so I've got my gappers and earnings scanners, and I've got my surging up scanners, and I've got my high relative volume scanners. So as soon as I set up my platform each morning, I have the same routine. I look at the gappers and I look at the stocks that are reporting earnings. Okay. So earnings plays, when we're in the season where we have lots of companies reporting earnings, they're going to be more active. Right now, the earnings are a little bit slower, so the gappers have been more based on other types of news instead of earnings, but that's okay. And in terms of the gap, I look for gaps of greater than 4%. I find the bigger the gap, the better for the gap and go strategy. I want to see something that has a big gap up, has lots of buyers interested in it, and then as soon as the market opens, look for that continuation. Gaps of less than 4% oftentimes are good candidates for a retracement or a gap fill. And a gap fill is simply, if we look back on this chart here, when the price, this window here, this little pocket, is filled as the price action comes down and then taps this lower line. So a gap fill is very common for stocks that are gapping 4% or less. Stocks gapping more than 4% have a higher likelihood of running. Okay. Now the other thing I scan for is simply pre-market volume. Sometimes there will be a stock that is gapping up, 3.5%, but it's on 3 million shares, and so it would slip through my gapper scanner, but I still want to be aware of it. So I scan also just for leading pre-market volume, and I sort it by highest volume. So I look at the stocks with tons of volume, and anything with light volume I'm not interested in. The only problem is that on that scanner, we'll sometimes get stocks like Siri, which may only be gapping up 1%, but has a ton of volume because the stock in general trades a lot of volume. Bank of America could be the same sort of thing. It might trade a ton of volume pre-market one day, but it's not really going to be of any interest. So we have to still filter out the watch list and the scanner in order to find the stocks worth trading each day. So each morning, my process for creating a watch list is to look at the top gainers, okay, the top pre-market gainers. So the stocks with the biggest gap and the stocks with the most pre-market volume. I simply mark out the high of the gap up pre-market, and I look at that spot, that penny, as the place that I'm going to buy. So if a stock is gapping up and has a pre-market high of 17 and pulled back to 1680, 17 is the spot that I'm looking to buy it, right? I'm looking for the new high, the gap and go. So it's got to break 17 and then squeeze. So I'm probably going to have my watch list marked to have a buy order of 1701, maybe 1702. All right, so as soon as that comes up with volume, I'm going to be interested. So I like trading the breakout. Okay, the breakout of the pre-market flag. That's one of my favorite setups for the gap and go. A stock that's gapping up and has a really nice flag pre-market. All right, so a stock that's gapping up but has a very weak flag pre-market, say it gapped up, uh, you know, to 17 and then pulled back to 15. Well, we're 2 points off the high, right? $2 off the high. I can't wait to buy it at 17 because I'm going to be chasing it $2 up. And do I really want to buy it at 15 because it retraced 2 points? I mean, that's kind of a sign of weakness. So on those ones, I usually decide that it retraced too much of the move and I'm not going to take the trade. Okay, so when I'm looking at my watch list, I try to see if there's any stocks on there that are former runners. Right? Stocks like Sarepta, for instance, that in the past have had really big days. So stocks that when they gap up historically, they go crazy. Those are stocks I'm going to be excited to trade. So, tomorrow if we see a stock like DGLY, Lake, NDRM, JRJC, those are just a few. If any of those were gapping up big time, I would be excited because I know when they have big days, they can get pretty wild. And that can be a lot of fun. All right. And if my watch list has stocks that in the past I know have been kind of weak and not fun to trade, like JCPenney or Arna or NQ, then I'm probably just going to say, you know what, this is gapping up, but I don't really like trading the stock. It's not easy to trade. It's very choppy, has a lot of market manipulation, and so I'm just going to avoid it. But it's good to get a little bit of a list going in your mind of stocks that are easier to trade. Right? What are stocks that you make money on, eight times out of 10 when you trade them? And then the stocks that you lose on 8 times out of 10, well, they should be on your no trade list. Okay? So I'll look at a former runner here, DGLY. This is an older chart, but still, we had this stock that was a former runner, made a move from $4 up to $33 in the period of like a week. So anytime this stock gaps up, lots of people jump on it because it has a very low float. There's a potential that every time this one gaps, that tons of buyers are going to jump in it and it's going to squeeze 20, 30, 40%, maybe more. So anytime there's a stock that has that history, retail traders are going to remember that. And the retail traders that are thinking, you know what, I could buy 30,000 shares of this thing and maybe it'll squeeze 3 points and I'm going to make 100 grand, right? There are traders with big money. They're going to see a stock like this and think it has huge dollar signs written all over it. So for us, again, we might only be taking 2,000 or 3,000 shares, maybe more, but the percentage gain potential is still there. Right? So we're going to focus on the same stocks that the big money is going to follow because we all know these are the ones that have a lot of potential. Now, it's worth noting follow-through days can be good, but they can also be risky. And we talked about this a little bit yesterday when we were talking about risk management. A follow-through day is the day after a stock had a huge move. Typically, the day after, the stock is going to trade only a fraction of the volume that it traded on the day of the breakout. So let's say a stock trades 50 million shares on the breakout day. On the follow-through day, it's probably only going to trade 25 or 30 million shares. Now, that might still be very high relative volume, but compared to the previous day, the price action is almost always going to be choppier. The exception is when the stock breaks to make new highs, because when it makes new highs, fresh buyers are going to jump in. Shorts are going to cover, and you can get a really nice squeeze. So when I'm looking at follow-through days, I focus primarily on breaking new highs. All right, and we'll look at a slide here. This is Lakeland. Okay, so the big day here. Actually, well, there's a couple big days. I guess the biggest day was this day here. The follow-through day had much lighter volume, but it did make new highs. And I remember when it broke over 20, it immediately popped about a point. So lots of buyers came in, jumped on it, shorts covered, and it squeezed. Okay, the next day it gaps up again, sells off a little bit, and then surges up. But again, it continues to be on lighter volume than the first breakout day. So even though it was a big percentage gain, it was a little harder to trade it on this third day of breakout. Okay, by the fourth day, we're starting to get a little bit of a sell-off. Okay, and this is common. And this fourth day, it wasn't able to make a new high, wasn't able to break the high, the previous high, or if it did, it only broke it by like 2 pennies and then came in. So this is common when a stock starts getting a little bit overdone. And if we look at our chart here on NDRM, this one I was watching off the watch list this morning, you can see its daily chart. We had a stock that surged up, big move, a bit of pullback, tapping the moving average, and now turning around to go. So initially, I was watching this over 1490. The first day it broke over 1490, I thought, okay, this is going to be the day that shorts are going to cover, and we're going to get a quick move back towards the upside. And there's a lot of potential there, 4 or 5 points, right? We broke the high of the previous day by only 15 cents, and then we sold off. So that was pretty disappointing. You know what was also disappointing is that we traded 40 million shares on this day, and 2 days later we only traded 1.5 million. But in a way, it's not that surprising because we have the big breakout day, and then once we're selling off, people don't really care about it, right? We're on to the next one. Where's the next one? Where's the next one that's having a big day like this? The retail traders, we all abandon this guy and go to the next one that's making a big move. Okay, but when it starts to come back up, we take interest again. So breaking 1490, that first day didn't do anything. The second day when it broke 1490.15, it made a clean move right up to about 16. So it broke it by about a point. And then today, when it broke 1465, it went up to 1645. It broke it by about 25 cents and then pulled in pretty quickly. So at this point, you can see again, lighter volume. It's getting a little overplayed. And this is very common. So these are fun to trade on the first day. It's fun to trade on the follow-through days if they're breaking and making new highs. But we also have to be careful that we don't over-trade them because they can become more and more difficult to trade. So, the first day I made a ton of money on this one. After I've had some really good winning trades, I try to scale back a little bit and not push my luck. And if I start finding myself taking losses, I'm probably just going to give up on the stock for a little while. So my last 2 trades on NDRM were both losers, and I said, I think I'm done with this. It's just too choppy. It's not trading in a way that's easy for me to work with. So I think I'm going to move on to something else that's trading with better volume right now. Okay, so the gap and go, we'll go over this more when we're talking about the actual strategy, but just in general, take note of the fact that stocks gapping up over 4%, we often see the pattern called gap and go, gap up, go up. These stocks gap up, and then they surge out of the gates with a tremendous amount of volume. In contrast, stocks gapping up less than 4% often sell off and fill the gap. Okay, so we'll review that more in Chapter 6. Now, gap down, go down. Stocks that gap down more than 4% oftentimes are going to also fill the gap and pop back up. Okay, so I find this a little bit interesting that stocks that have the big gap down, that they often pop up at the open. And I'm not sure exactly why that is, if it's people that are covering their position or people that are averaging down on their long positions. People that see the big gap down as possibly a buying opportunity, but I don't usually see the quick drop right out of the gates on stocks that have had a big gap down. Okay, so a big gap down, honestly, there's a lot of times where I look at these as buying opportunities because the stock is now so cheap. And I just have a general long bias on the market, so that's part of the reason that I look at it like that. But stocks gapping down more than 4% can actually be a buying opportunity. But in general, I try to trade with the trend. So, gapping down, obviously there's a sign of weakness there. There's a reason it gapped down. So I usually am going to try to avoid taking that kind of trade. I would take a trade like that if there was like nothing else that looked good, and I would still go with smaller size. There's a potential there, but it's not my favorite. Okay, so once I have my watch list each day, I'll keep those stocks on watch until they prove to me they're not worth watching. Now, if you think of this, watch 4 stocks all day. Watch 4 stocks all day long. You're guaranteed if a pattern forms, you're not going to miss it, right? If there's a pattern that forms on any of those 4 stocks, you're not going to miss it because you've been staring at them all day long. So watching the 4 stocks with the highest relative volume can be a good opportunity to find trades. You'll typically be able to find a trade opportunity in one of those stocks at some point during the day. So, if there's a point where NDRM, for instance, today starts selling off and you initially had a long bias on it, well, you can take it off your watch list and replace it with a stock that, wasn't gapping up, but right out of the gates had a lot of volume, and so it was, it's now on the watch list. Or a stock that had a lot of news intraday and a big price move to follow, so that's worth watching. All right, so as the day progresses, I may add stocks to the watch list or take ones off that have failed. So we can adjust our watch list throughout the day as the market is changing, right? So with the breaking news, as you guys know, I listen to Benzinga. Everyone, at least that's in the chat room, knows this. I listen to Benzinga. Breaking news can turn a boring day into one of the biggest days of the year, and today was a good example of that. We had breaking news on DKS. Okay, so we have to be selective about what news we're willing to trade, but let's look at DKS. So this spiked up at, let's see, what time was it? It was right about 12 noon, 12:05. It spiked up. The news was that they are considering going private. Okay, so this sounds very interesting. This spikes up 10% and is halted for 5 minutes. So we got a big spike and that's halted for 5 minutes. All right. So the high was 53.37. When it reopened, it spiked up to 55 and then pulled back. That's very common. And what I usually do with these news plays is I wait for the dust to settle and then I take a long position. I tried to get long this at $55 and I didn't get filled on my order. It popped up to 55.45 and then up to 55.90, and this was pretty much in one clean move. And then it pulled in a little bit. But still, that was a good opportunity there for a winning trade. Unfortunately, it just didn't work out for me because I couldn't get filled. Okay, but in any case, this type of news in the middle of the day, on a day which otherwise was fairly slow, can make things very interesting. So this is one of the reasons that I like to stick around all day long, even if I'm having a slow day or a boring day. I just keep the news on and I just wait for that possibility that we'll have some breaking news. Because every now and then we'll have a stock like this that breaks out and runs up 30%. Or maybe we're able to buy it and get a nice trade on it and then sell it, and then it sets up again later in the afternoon after a period of flagging and consolidation. This right here, the way it was flagging along the moving average, for a little while it was looking like it might set up for another long position, but as it turns out, it didn't. Okay, so this stock is worth trading because at 12 noon, tons of volume came in. That made the stock suddenly worth watching. Now, let me just quickly show you Loco. This was a chart that I was watching today at the open. Okay, at the open, we had a nice quick move up to $24 on high volume. Right, you can see the big volume here. Big volume, spikes up to 24 and then pulls back. I was considering taking a long position on this, but there was 2 things I didn't like. One, it pulled back a little further than I would have preferred. I would have preferred to see it consolidating in the top 25% of the move, and it retraced closer to the 50% mark. So that's the first thing. The more it retraces, the more sellers there are, so I'm not crazy about that. But it's got a high of 23.96. Okay, so we consolidate here, and then all of a sudden we make a move up. And one of our students was saying, Ross, do you think this looks good for a long over $24 right here? And I said, well, this stock had a lot of volume at the open, but the volume has really died down a lot. Buying this at 12 noon, there's a couple problems. One, it's the wrong time of day to buy this type of breakout because it's too far away from the stop and there's not enough volume. Number two, how many green candles do we have in a row? 1, 2, 3, 4, 5, 6, 7, 8. Statistically, you're not going to have, the more green candles you have in a row, eventually, inevitably, there's going to be a red candle. So the longer the stretch is, the higher the likelihood that we're going to have a red candle. So I don't like to buy after there's already been 5, 6, 7 green candles because the percentage that the next one's red is just too high. Okay, so too many green candles in a row, not enough volume. Number two, this is a double top, and the pattern here is a W, right? So we have this top up here, pull back, a little bit of a wave here, pulled back, a move back up. These are oftentimes reversed. So does this mean you should short it? Well, you have a better chance of making money on the short side than the long side, but I still wasn't interested in shorting it because it wasn't my favorite setup for a short either. Okay, so now it's starting to consolidate during lunchtime. So I still had it on watch, and I thought, well, you know what? Here's the problem now. Even though we're getting this consolidation, oops, let me draw that again. Even though we're getting this consolidation here, and we are flagging on the 5-minute in a fairly nice way, the problem is we're still lacking the volume. And right here, we came up to 24, we pulled back. What are the odds that this is going to have a big breakout here and go to $24.50 or $25? It just doesn't have the volume, right? And what happens? It pops up to 24.06 and then it drops down to 23.80. It fakes everyone out. Everyone that jumped in here and bought it got faked out. And yeah, there was a bit of a volume spike here, but relatively speaking, since the morning, since the open, the volume has been very, very light. So, there was potential in this one, but there were a couple of problems. Too many green candles on the first entry. It was a double top on the first entry. There was low volume on the first entry. By the time it set up for a second entry, we still had the problem of low volume. So this is an example where we can find patterns on charts, but if we don't have the corresponding volume, odds are they're not going to go in our favor, and we're going to get really frustrated because you're going to look at this and you're going to say, this is a really nice looking flag. And it was. I mean, it's really not a bad looking flag at all. It could be a little tighter, not have as much space in here, but that's being a little picky. This is not a bad looking flag. The problem is that buying it up here is a little high off its support level, off the closest stop, but the real issue is that there's not enough volume. Okay, so that's why we have to focus on finding the volume and then applying our chart patterns to the stocks with high volume, not the other way around. So that's one reason why I don't get super into scanning or trying to scan for chart patterns. One reason is that the computer has a hard time recognizing chart patterns, and while that's a disadvantage for us when we're trying to scan for them, it's actually our advantage as retail traders because the computer systems aren't able to identify patterns of bullishness or bearishness in the same way that we are. Okay, so that's one thing with the scanners. And secondly, when I do have scanners that are sort of approximately returning what I would consider to be a flat top breakout, I'll get stocks like Loco, and I look at the pattern and I say, that looks great, but it doesn't have the volume. So typically the stocks that have high volume, I'm already watching them, right? The ones that are having a big day, I'm already watching them. So when the pattern forms, I'm going to see it. And everyone that's in our classroom, in the chat room during the day, we've got so many eyes on the market watching these high volume stocks that usually if there's a good pattern forming in one of the big ones, we're going to know about it. So, that's one of the things with the scanners that I don't spend a lot of time trying to write the flat top breakout scanners. I do have some that I use, but I don't rely on them very heavily because most of the time the alerts are not very good. I could have it sort and only give me alerts for stocks with super high relative volume, but even still, it's just sort of easy. It's just easier to keep an eye on the stocks that have a lot of volume than try to go the reverse way by scanning for patterns. Okay, so your question there about buying Loco, if I would buy it at the breakout then around 12:30, yes, at 12:30, on the one hand, you do have a tighter consolidation right under 24. If it had broken up to 24, that would have been a better sign, but we're still lacking the volume. So stocks are going to break out and make a clean move when they have lots of buying volume. And without that buying volume, they're usually not going to make a clean move. So the lack of volume is what would make me say it's not worth trading. Okay. So on the news with DKS, I tried to take a trade on that. I was willing to take a trade on it because of how much volume surged in, but I wasn't interested in it, in the afternoon once it started fading because I just didn't think, at that point it was starting to sell off. And it just didn't look good for a secondary trade. But the first trade looked good. Typically on a news play, I look for the first trade, look to get long on the first pullback, whether it's a pullback on the 5 minute or the 1 minute. That's something I'm going to be interested in. And sometimes, a news trade or a news will cause the stock to spike up, and then it's just really not good for a trade. We can't get a tight stop, or the volume dies out really quickly, and it's just not worth touching. So we have to be selective about what breaking news trades will take. Right? And the whole thing here is that trading the news can be very risky. When a stock suddenly jumps up 2 points, right? If it goes right back to where it came from and we buy at the high, we could be at a really, really big loss. So the safest way to trade this type of news is just to wait for the first pullback. That's when the smart buyers are going to come in. And if we see a lot of volume coming in the first pullback, then we know those smart buyers are jumping in. So they must know and be able to recognize that this news is strong and it's worth buying up. So we want to join the smart traders and not be one of the traders that buys as soon as we hear there's news on XYZ and then all of a sudden be down 1.5 on 2,000 shares. That can just be really risky. Okay. And then to answer your question, I really do try to always wait for volume to pick up before the breakout. Now, if the stock has high volume during the consolidation, the way Zillow did, then that's something I would consider taking a stab at because it already has really high volume on the day. There are times where I will take a breakout pattern like that, but it's really going to be case by case. It's going to depend on the daily catalyst, the daily chart, how many people I think are watching it. Loco, it had some volume today, but at the time where we were looking for the breakout, I just didn't have the confidence that it was going to go. So, for that particular one, the setup just wasn't there. So second question, why is it that there's stocks that have big pre-market volume and gap up, but then little volume after it opens? Well, sometimes a stock is going to gap up. There's going to be some news pre-market, causes the gap up, and then once the market opens, there's just not a lot of retail interest. So whoever was buying pre-market, sometimes there'll be a stock that has 500,000 shares of pre-market volume, and it all came in 1 minute. So it was it was like one buyer that came in and, they bought 500,000 shares and now no one else cares about the stock. So that can happen sometimes. It's sort of group mentality where if we have 10 stocks that are all gapping up really nicely, inevitably whichever one's moving the fastest is going to get all the attention. So even though the fourth or fifth one might be a nice gap up, it just might not get as much attention because there's something else that looks better. It could also be related to overall market conditions. If it's a kind of weak day in the market or the market is selling off right at the open, people might be a little more hesitant. That could be another reason. But, for the most part, the stocks that have a lot of pre-market volume. And when we talk about a lot of volume, one of the measures, we can look at the float of the stock, how many shares are outstanding, and we can look at what percentage of the float has traded pre-market. So a stock that has a float of 10 million shares and is trading a million shares pre-market has already traded 10% of its float pre-market. So if we look up that stock and we find that there's some good news, some good catalyst on it, there's a really good chance that it's going to open and really surge out of the gates. On the flip side, a stock that has a float of maybe 75 million shares and is gapping up on like 30,000 shares of volume, um, when the market opens, it may or may not attract as much interest. It just may not have as much potential on it. The daily chart may not be as good, and people may just see that and just not be as interested. So if there's a stock with higher amounts of relative volume, that one's probably going to get the attention instead. Okay, so remember, when you're looking at your watch list and when we're looking at the stocks that we're going to trade, we always want to trade stocks that have the potential for a big winner. And I'm not swinging for the fences. I'm just trying to get on base. That's all I'm trying to do with my trading. I'm just trying to get, a couple hundred here, a couple hundred there. Occasionally, I'm going to get a really nice winner, and I'll get $1,000 or $2,000. But typically, I'm just trying to get get on base, get a $500 winner. Just get a little something out of the gates and then give me that cushion on the day so I can start being a little more aggressive. Right? But if a stock doesn't even have the potential to be a big winner, then that's a problem. Because say the profit potential on a stock when we look at our profit target is 50 cents. Well, we know we're never going to catch the bottom and the top of a move. So if we're able to capture a fraction of it, if we're able to capture even half the move, that's pretty good. So in that case, 50 cents is the target. Half the move would be 25 cents. So that's not a huge profit window, but that's something. On the flip side, when we have a stock like Arna that's moving up in 8-cent blocks, moves up 8 cents, then down 5 cents, then up 8 cents and down 5 cents. It's really hard to capture profit when the moves are that tight, right? So you have to use larger size and take smaller wins, but then you really don't have that home run potential unless you're willing to give it just a lot of room as it's stair-stepping its way up. Okay, so we want stocks that have home run potential, but we also need to be able to apply our risk management techniques to any stock we're considering. There's a few stocks that are in the $250 price range that when they have a big day, they can move like 50 or 60 points, but they're extremely hard to trade because they have $1.50 to 2-point spreads. So on the one hand, you could think, well, look, this has the potential to go up 30 points, but realistically, managing your risk on it is going to be really, really hard. Okay, so stock selection essentially is our second level of risk management. So yesterday was the first level of risk management. How to set stops, how to find a profit target, how to use profit loss ratios to manage your risk, really. How to use that so you can trade with a percentage of success even as low as 50% and still make money. So our second level of risk management is learning how to choose the right stocks. So we're going to apply the first level to the second level, right? So we're only going to look at the right stocks. Now, the next thing we'll get into is how to find patterns on the right stocks, right? So we're going to keep building on what we're learning. So risk management, choosing the right stocks, choosing the right patterns, and then we're going to talk about the actual strategies that I use to trade every single day. Okay, so that's it for today. Anyone that has questions watching the recording, feel free to shoot me an email, ross@daytradewarrior.com.